All right, we have more changes unfolding in the U.S. economy and in the U.S. housing market. Changes that have the housing recession entering its next stage as mortgage rates drop bigly, almost 150 basis points in just over a month. This is causing a massive shakeup in the market. And if you're a home buyer, it's good news. If you're a home seller, I'd get moving and list your home while prices are still elevated as inventory is beginning to normalize. And with that, so will home prices. So we'll look at what's happening, what changed in the last couple of weeks, because a lot has with regard to real estate, especially residential real estate. We'll also look at home builders and their sudden interest in single family, as new numbers were just released that show new houses are coming, folks, and lots of them. Also, rents finally breaking in the right direction. A lot happening, a lot to get to, but before we get started, press the like button and subscribe. It helps the channel out, and I appreciate your support. Also, check out our new daily show over on the Notify America YouTube channel. Just launched last week. The link is in the description. So the market, folks, the market has been on a tear for the last week, but this is going to end probably sooner than later. All indicators are showing how overbought this market is right now. We have the fear and greed index showing we're sitting at extreme greed levels. Also, the daily RSI on the S&P 500 is now trading at 82.2, an all-time record high. Only like one or two other times ever has the RSI crossed 82 on the S&P, and shortly thereafter the market has come crashing down. So be careful right now. Don't get FOMO, don't get carried away. This is why there's a name for this, the Christmas rally. Every year the Fed manages to pull this off somehow, hoodwinks the market before a giant rug pull. If you didn't watch our last video, we explained why they did this, purposefully spooking bond markets into loosening financial conditions, causing a crash with interest rates. So why would they do that? Well, besides helping give a boost to all the big banks who want to lock in, these big year-end bonuses, they know the next 2 quarters are going to get rough, especially for small business. There are tens of thousands of small and mid-sized businesses with loans set to mature early next year. The Fed has thrown them a lifeline. When those loans begin resetting in a few weeks, their new rate will be 100, 120 basis points lower than it would have been. Which may not sound like a lot, but it is, folks. When you're a company, that barely breaks a profit, 1 or 2 points can mean the difference between staying open or going under. Remember this, watch.
Right. And there is still stuff to happen there. We know that a lot of corporate bonds, for example, they're about to reset. And those resets are going to come in at interest rate levels that are 2 or 3 percentage points higher than they were previously. And that's going to be a drag. I hear the same thing in commercial real estate, where there are a lot of people who are expecting some of these buildings to struggle to hit the valuations that were projected in the previous lower interest rate environment. And that's going to be some disruption as well.
Now, turning over to the housing market, a lot of breaking news on housing this week, folks. Housing supply versus active listings, 2 very different things. Most of us know that we don't have a supply issue in this country. Instead, we have a shortage of active listings. There's plenty of supply. It's just off market. Something needs to happen to push those existing single-family houses, back onto the MLS, take them off the sidelines and put them back into play. Well, it looks like that may be happening right now after the Fed's epic screw-up last week. The language that they used, telegraphing their plan for coming rate cuts, spooking bond markets into motion, causing interest rates to crash. You could see here the 30-year fixed-rate mortgage now close to 6.5%. That's 150 basis points almost below its all-time 2023 high. That's a big difference. 1.5 points in 45 days is something you rarely see happen. Well, it's jimmied the door open, and a massive inflow of sellers came rolling out, jumping at the chance to list their homes while they still can. Redfin reports this: price growth slowed for the 3rd straight month in November as supply crunch eases. U.S. home prices rose just 0.6% from a month earlier, the smallest increase since June, as a jump in homes for sale gave buyers more options. That's according to the Redfin Home Price Index, which is similar to but more current than the Case-Shiller Index. Now, a lot of people incorrectly assume, especially realtors, that home prices will begin rising when mortgage rates fall, something that I completely disagree with. You'll hear them say that all the time. As soon as rates fall, prices are going to just balloon up all over again. But they're assuming, and wrongfully assuming, in my opinion, that there are home buyers out there that can afford to buy these houses, which, there may be, but nothing like there were a few years ago. Home prices are just too damn high right now. We're no longer in 2020. The majority of prospective buyers in this country have exhausted their savings. The pandemic stimulus is over, and the era of free money is over as well, at least until we fall back into recession. What they also assume is that there will be more buyers than sellers as mortgage rates start to fall, but there won't be, at least not right away. There may be a lot of people who would like to buy a home, but that doesn't mean that they can, not at these prices. And for some historical context, mortgage rates fell also during the Great Financial Crisis, but home prices didn't bottom out until 2012. You can see mortgage rates during that period on this chart. Home prices, as we all know, peaked around 2006, 2007-ish. But look what happened to mortgage rates, folks. They were falling and falling and falling until home prices bottomed in 2012. So no, just because rates are coming down, that doesn't mean home prices will just shoot right back up like we saw in 2020 and 2021. It's more likely the opposite happens. Now, along with that, rents are now starting to fall. Finally, we've been waiting for rents to fall. People have been talking about it for the last year, and it's finally happened. Redfin writes this: the tide turns for renters as asking rents post biggest decline in over 3 years. The median U.S. asking rent declined 2.1% year over year in November to $1,967, the biggest annual drop since February 2020, and fell 0.6% from October. You can see the median asking rent here finally falling into negative territory. This is something that the Fed's been waiting for all year long. Well, this could be just the beginning for a crash in rent prices. Take a listen to Jerome Powell last month explain this. Watch.
Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well.
And to top it off, housing start numbers were released yesterday, and they were big, folks. This is from Goldman Sachs, writing housing starts surge in November. Housing starts increased 14.8% in November to 1.56 million, against expectations for a modest decline, as single-family starts rose by 18%. You can see the spike on this chart here. The red line is single-family housing starts. The blue line is multifamily. Both increased in November, but single-family just shot to the moon, and unexpectedly. Look, we've been saying for the last year that inventory will begin to normalize. There's no way to know when exactly that will happen, but don't believe all the naysayers out there who tell you that this is just like the new normal, the new reality. Inventory is where it is, and it's gonna just stay at these levels forever. That's complete nonsense. If you want to track inventory, by the way, and active listings in your local area, you could do so with SnapForest. The link's in the description. You can see the redder a county is, the more inventories fall, and the bluer your market is, the more active listings have risen. You can see markets that are blue are the same markets where prices are falling. But all these red areas have been jammed up. Homeowners who want to sell but can't bring themselves to do so with rates as high as they were. Well, there are reports that with mortgage rates falling to 6.5% now, it's loosened that logjam up a bit. Once the fixed rate falls even more to around 5%, that's likely when we'll start to see a wave of listings flood back onto the market. And look, 3 years ago, things were different. Everyone, or almost everyone, had a lot of money saved up, and we were in the inflation stage of this housing bubble. The market was just bubbling up and bubbling up. Well, we are on the other side of that now. Seeing a 30% rise in home prices in 2 years is not going to happen again. All right, that wraps up this video. I hope you enjoyed it, got something out of it. If you did, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.